Hello, everyone, and welcome to the International Monetary Fund. We're delighted that you could join us for this online discussion. I'm Tobias Adrian, the Financial Counselor here at the Fund and Director of the Monetary and Capital Markets Department. I'm delighted to welcome you to this discussion on new monetary policy tools for emerging markets and developing economies. It's a pleasure to connect with such a group of academics, practitioners, and policymakers from around the world. Today, we are honored to have a very distinguished group of speakers with us. Let me first introduce the speakers on our panel that I will moderate. We have Lesetja Kayongo, who is Governor of the Reserve Bank of South Africa. We also have Elvira Namuliana, the Governor of the Bank of Russia. Our third speaker is Herman Reinhardt, who is Senior Vice President and Chief Economist of the World Bank Group. We're also very fortunate to have with us today Bo Lee, the IMF's Deputy Managing Director. I will give the floor first to Bo to provide opening remarks, and then we will proceed to our panel discussion. Bo, the floor is yours.
Thank you, Tobias. Dear friends and colleagues, I'm very pleased to welcome you to this panel discussion on the use of new monetary tools, monetary policy tools in emerging markets and developing economies, or EMDEs. I would especially like to welcome our esteemed panelists, Governor Kayongo, Governor Biolina, and Senior Vice President Reinhardt, as well as our moderator, our very Tobias Adrian. I'm very much looking forward to hearing our distinguished panelists' views this morning, and I'm most pleased to have this opportunity to provide some opening remarks. Unconventional monetary policies, including in particular asset purchases, have been used extensively in advanced economies for some time, especially in the aftermath of the global financial crisis. These policies have helped to ease stress and improve market functioning. In addition, in an environment where interest rates were constrained by the effective lower bound, large-scale asset purchase programs also aided monetary policy transmission and provided needed stimulus to support faster recoveries and boost inflation towards central bank targets. Since the pandemic, we have seen many EMDE central banks joining this advanced economy counterpart in deploying asset purchase programs, along with other unconventional policies. But since most of the EMD central banks still have room to cut interest rates, the range of unconventional tools has been narrower than the advanced economies. There was little reliance, for instance, on negative interest rates. And also the motivation, the use of these tools, these unconventional monetary policy tools, has been related more to easing financial stresses than to providing macro stimulus. Well, the good news is that so far, these ventures into unconventional monetary policy seem to have been quite successful. EMD banks have managed to lower government yields and significantly reduce financial market stress, while avoiding noticeable capital outflow and depreciation pressure, which was a concern that often held back from using these tools in the past. Given this overall positive experience, it's likely that EMD central banks may consider asset purchases during future episodes of market turbulence. But we should also be cautious and remember that our experience with purchase programs is still relatively limited. Moreover, these policies also come with considerable risks, some of which may be accentuated in the EMDE context, given their often limited market depth and less well-developed institutional frameworks. Here I want to highlight 3 risks in particular. First, EMD banks will have to decide on how much maturity, credit, and exchange rate risks they are willing to take upon balance sheets. Second, they will have to consider the risks of fiscal dominance that may be associated with large-scale purchases of government securities, especially if done to the primary market, as well as the broader governance challenges and political pressure that may emerge if central banks support non-bank financial institutions or set up funding for lending programs and supporting particular sectors. Finally, many central banks, many EMD banks must now address the challenge of exiting from these programs without triggering financial instability and without running afoul of political pressure to minimize borrowing costs. Political pressure that are likely to be all the more acute in the current environment of rising interest rates and high public debt. In short, the key question, we think, is whether and how EMD central banks can benefit from asset purchase programs and possibly other unconventional tools while containing risks in the 3 areas I outlined. A recent IMF departmental paper led by Tobias and colleagues provides some important insights. But this is going to be a continuous learning process. It is very much in this spirit that my MCM colleagues have organized this discussion this morning. And I'm most interested in the insights that the panel will bring to bear on this important and complex topic. Thank you. Thank you, Tobias.
Thank you very much, Bo, for nicely framing the key issues that we're going to cover in this discussion this morning. I'm very pleased to serve as the moderator for this panel. I would like to spend a couple minutes briefly overviewing my new paper that Bo just mentioned. I'll begin by noting that central banks have made great progress in developing the credibility to conduct countercyclical monetary policy. This reflects substantial improvements in their monetary policy frameworks, often in the context of inflation targeting, that have allowed them to achieve much better inflation stability as well as exchange rate flexibility. The benefits of this heightened credibility were clearly evident during the COVID crisis, when EMDE central banks cut interest rates substantially and also initiated asset purchase programs. While using asset purchases to support market functioning can be regarded as a core function of a central bank, many EMDE central banks have been reluctant to do so in the past for fear that it would cause a market backlash and lead to capital outflows. As it turned out, EMDE asset purchase programs were clearly beneficial in assaying financial stresses during COVID. Some EMDs may well consider using asset purchases for macroeconomic stimulus sometime down the road if they again experience a return to very low inflation. However, asset purchase programs can help EMD central banks achieve their mandated objectives. They also pose substantial risks, including both to central bank balance sheets and ultimately to central bank independence. My recent paper on asset purchases and direct financing with my colleagues Chris Ursek, Simon and Ratna Sai provides some guiding principles aimed at harnessing the benefits of asset purchase programs while containing the risks. One core principle is that the central bank must have the latitude to adjust its policy rate as needed to achieve its mandated objectives. This is critical. Central banks pay for the assets they buy through issuing reserves. These extra reserves would spawn large inflationary pressures unless the central bank can sterilize them by raising its policy rate to a level consistent with price stability. A closely related principle is that any asset purchases the central bank makes should be on its own initiative and to achieve its mandated objectives rather than the government's objectives. The size of asset purchases should be calibrated in a way that is appropriate for attaining those objectives, i.e. the central bank's objectives. And the program would be wound down as progress is made in achieving the objectives. This principle is important when taking into account that central banks have often been forced to undertake asset purchases at the behest of the Treasury to achieve the latter's objective of minimizing the level and volatility of government borrowing costs. Such pressure to serve fiscal rather than central bank objective is known as fiscal dominance and has often led to poor macroeconomic outcomes, including runaway inflation. One way in which the risk of fiscal dominance can be reduced is by ensuring that central bank asset purchases are made in the secondary market rather than allowing the central bank to directly finance the government through primary purchases or through an overdraft facility. Direct financing provides an easy out for the government to determine both the size of central bank balance sheets and the interest rate that it will pay, and increases the risk of debt monetization. While exceptional circumstances such as COVID may justify some direct financing if the primary market becomes severely impaired, such an expedient should be temporary and end when market stresses abate. Finally, our paper emphasizes the importance of a strong fiscal position. A central bank conducting asset purchases should aim to ensure that the government can provide fiscal backing to cover losses. Such backing is needed to preserve the central bank's financing autonomy and allow it to make policy decisions to achieve its mandate objectives rather than based on concerns about its financial position. Moreover, the fiscal authority is more likely to resist the temptation to seek cheap financing from its central bank if its position is strong. While asset purchase programs by EMDE central banks are quite new and modalities must be worked out, these principles should help provide a solid foundation. With that, I will turn to Lesetja for his opening remarks, followed by Elvira and then Carmen. Lesetja, the floor is yours.
Thank you very much, Tobias, and good to be part of the distinguished panel. A few remarks. First, the use of unconventional tools such as asset purchases and lending operations has indeed gained popularity amongst EMDEs, especially during the COVID-induced financial market crisis. According to the estimates of the BIS, the number of EMDEs that used asset purchases and direct lending operations has at least doubled since the global financial crisis. The unprecedented use of unconventional tools was consistent with the uniqueness of the COVID-19 crisis shock experience. Firstly, the propagation of liquidity shocks in financial markets was faster and more intense. Secondly, the level of stress experienced at the height of the crisis was higher than stress experienced in previous crises. Third, space for maneuverability was limited, especially in EMDs. And fourth and last, reliance on interest policies in countries which were close to the effective lower bound was not deemed sufficient to stave off the macroeconomic shocks resulted from the lockdown. This characterization of the macro-financial backdrop that informed the choice and scale of policy responses across advanced economies and EMDEs is common across recent studies of COVID-19 crisis. The South African Reserve Bank was among EMDEs that implemented unconventional policy tools. I should stress, however, that this was for purposes of protecting the stability of the domestic financial system, which was under threat from liquidity strains in the domestic market and low currency bond market. The SARB not only had to deal with COVID-19 ramifications on the markets, but had the added challenge that South Africa was removed from the World Government Bond Index, and the last of the rating agencies downgraded sovereign to below investment grade. The SARB's response comprised purchases of government bonds in the secondary market, as well as lending with commercial banks. Coming out of this process, there are a number of misconceptions and challenges that are worth addressing, which we could revisit during the discussions. First is how we characterize the bond purchases. The bond purchase program can be thought of as policies that sit along a spectrum measured by the motivation behind the adoption of the tool. So following a characterization in a paper about asset purchases and direct financing recently published by the IMF, on the end of the spectrum are small-scale asset purchases, which are usually deployed to address dysfunction in core markets, and on the other are large-scale asset purchase programs, which are used as tools for monetary policy accommodation. In many instances during the COVID-19 crisis, the main motivation for using asset purchases as unconventional was to address financial stability risks, particularly in EMDEs. This nuance is important in the characterization of the tools either as unconventional central bank tools or as unconventional monetary policy tools. In practice, this distinction can become blurred when asset purchases are not used strictly for the intended purpose and, as it were, morph into something else. What is clear from some of these studies is that the purchase program implemented during COVID-19 crisis were initially intended to deal with impaired functioning of core that are central to the transmission of monetary policy or pose threats to the stability of the financial system. The bond purchase program in South Africa was intended purely as a tool to address market dysfunction. It was never intended to provide monetary accommodation, nor was the program intended for deficit financing. The latter is important to emphasize so as to dispel misconceptions about the program. This also informed the decision to not purchase bonds in the secondary market, even though the central bank is permitted by law to buy bonds directly from the government. All communication consistently reiterated these points. Certainly in South Africa, the interventions implemented during the COVID-19 crisis were not considered as part of the deliberations of the Monetary Policy Committee. The second lesson is that it is not about the size, it's about effectiveness. After all, it's not about how much medicine you administer, it is whether the medicine works. The premise, therefore, should be that more liquidity is provided when the market needs it, and that the quantum is reduced when signs of normality emerge. Policymakers should not underestimate the power of signaling or the mere presence of the central bank in the market, as oftentimes this is enough to stabilize the markets. The third lesson, and I will bring this to a close, is the issue of dominance or perceptions of deficit financing. The stance that we had taken was partly informed by concerns about fiscal dominance, a risk that appears to be more pronounced in EMDEs. Interestingly, the risk of fiscal dominance or perceptions thereof is thought to be greater with asset purchases if the underlying asset is sovereign debt and much less for lending operations. there are two issues the central bank should pay attention to in order to avoid these misconceptions. The first is a precondition regarding autonomy, and the second is a precondition is how the central banks judge and communicate the effectiveness of the unconventional policies tools. It is not uncommon that the effectiveness of the asset purchases program is assessed on the basis of the impact they have on the bond yields rather than on liquidity conditions. To my mind, it would be wrong to measure the success or otherwise of the asset purchase program in terms of whether it has brought bond yield lower or not. For me, if the intended purpose was market function, that should be the focus, and it should be thus market function. And let me just conclude to say that there might be other issues. The first being, the other being the moral hazard, that the risk that market participants adapt their behavior by taking excessive risk because they expect the central bank to backstop all tail risks. The second is the duration of the intervention and the exit. This is the argument for market function is a temporary phenomenon, and if interventions aren't implemented as such, they setting up a new equilibrium that may not be a true reflection of economic fundamentals. So let me end it, Tobias, and hand back to you.
Thank you, Lesetja. Thank you, Lesetja. That was very clear. Let's turn to next.
Thank you, Tobias, and I'm glad to share my views on the issue. Let me start with reminding the audience that last year, Bank of Russia was one of the few central banks which did not use asset purchases as a policy tool. Nonetheless, the long end of Russian government yield curve at the peak of the market volatility increased by a similar amount as yield curves in countries which used asset purchases. We achieved this result by conducting more conservative monetary policy than others. That is, we started massive decrease in interest rate only after market stabilization, targeted foreign currency sales, regulatory forbearance measures, and additional medium and long-term liquidity provision tools helped to stabilize the market, including the market for government debt. Most importantly, the market was supported by strong fundamentals, mainly low government debt. Our logic last year was that asset purchases may significantly undermine central bank credibility, if not in the short run, then in the long run. Purchases may be interpreted by the market as a signal of fiscal dominance, which complicates monetary policy and financial stability actions. Has our view on this issue changed now, when we saw the result of this policy instrument as a financial stability and monetary policy tool in a number of emerging market and developing economy countries? I should say that it changed only slightly, if at all. Last year experience has demonstrated that central banks, which have significant credibility space, can use some of it to exercise asset purchases for financial stability purposes. Both asset purchases and communications can be designed in such a way that allows to minimize damage to credibility. Nonetheless, the key policy question for us should be whether this tool should become a standard financial stability tool, or whether we should reform the markets and create buffers to decrease the need to refer to this policy tool in the future. I agree with the conclusion of the paper by Tobias and his colleagues that financial stability should be of a very limited duration. That is, they should be seized once market dysfunction is over. They should be clearly communicated as temporary. I also agree that they should be conducted at the secondary market. The case for primary market is much riskier for me. Targeting long-term interest rates from the point of view of financial stability, I think, is counterproductive. So such operations should be designed in volumes of purchases. Our experience with other financial stability operations also shows that it is crucial for preserving market credibility to unwound asset purchases within a reasonable period of time. In the bank-dominated financial system, as in Russia, traditional refinancing tools backed with collateral with finite repayment time can be used instead of asset purchases. This time frame anchors the expectations that this is a liquidity provision that allows automatic unwinding. I agree that a particular nature of the market dysfunction or the range of financial institutions coming under stress, maybe such traditional refinancing tools are not able to reach and fix critical points of vulnerability. Such situation indeed creates a rationale to prefer asset purchases over refinancing operations. In such case, the issue of unwinding operations become trickier. Preferably, such plans should be communicated from the very beginning. In any case, in emerging markets and advanced economies alike, regular reliance on asset purchases as a financial stability tool creates moral hazard, and Mark Carney called it in his book financial dominance. The consequences are similar to fiscal dominance. They include potential future obstacles to proper conduct of monetary policy, as central banks may be afraid to rise interest rates because of financial stability considerations. Therefore, there is a strong case for reforming banking financial institutions and making them less vulnerable to shocks. This is, of course, the global issue and not the issue for the emerging markets per se. To decrease the risk of fiscal dominance, obviously, strong macroeconomic and fiscal rules are needed in the relatively calm times. We also need to use calm times to restore of buffers, which we use during the time of shocks. And then a few words on asset purchases as a monetary tool. Emerging markets, where interest rates before the pandemic were close to the zero low bound, use this tool as well as foreign currency purchases for monetary policy purposes. Such countries usually, by definition, enjoy more policy credibility. Otherwise, their interest rates would not have been low at the first place. Exit strategies are important consideration for them as well. If the QE quantitative easing is not followed by QE tightening, when the monetary policy normalizes, then such QE will be reclassified by the market as a monetary finance. And it surely will permanently reduce monetary policy for the future. First and foremost, because at the next instance, the economic agents and markets will not take it as a QE, but will treat it as a monetary finance from the outset, based on the past experience. And as we all know, the amount of permissible monetary finance is related to the credibility and trust in the central bank. Thus, this dynamic has an unpleasant fear of a vicious loop. The more steps you make along this path, the shorter the path gets before it ends at a cliff where the policy space for unconventional policies is exhausted. And since the end path is not clearly visible, I tend to believe that going along it is quite risky for any central bank. To summarize, unwinding previous measures, rebuilding buffers, and strengthening financial institutions is a more promising, although more difficult, way forward than simply relying on asset purchases as a policy tool. Finally, I would like to say that our position not to use asset purchases is based on three main arguments. First, we think that long-term moral hazard and credibility risks are higher than short-term benefits. Second, it is preferable to use less supportive measures such as liquidity provision and targeted and temporary forbearance measures. And the last, but the most important, we should work on decreasing the need to use such instruments by building buffers and reducing vulnerabilities. I'll stop here for now. Thank you.
Thank you. Thank you so much, Elvira. That was, again, a very, very clear and broad explanation of the views from you. So let me finally turn to Carmen, Carmen Reinhardt.
Thank you, Tobias, for inviting me to this wonderful forum, and I really do agree with what's already been said, and I certainly share the views in your paper that should take any lesson from the experience of 2020 and COVID rain of salt. It was indeed exceptional. I'd like to focus my remarks around two words: exceptionalism, and the other one is turning point. And let me start first with exceptionalism. If you go back to 2020, last year, this is, as has already been noted, really a very across the board, almost certainly a very widespread experiment, and the first time we see this kind of very systematic, concerted, counter-cyclical policy in emerging markets. And so my takeaway is that, above all, be exceptionally cautious in drawing lessons from 2020. For the word exceptionalism, 2020, during 2020, if you look at, and this is a World Economic Outlook, you look at the 196 countries in the WEO, 90% of the countries had a contraction in per capita income in 2020. 90%. That is a higher share. We, in work that I've done with Catherine Holstrom, we've gone back to 1900, and 90% is higher than what we saw in World War I, what we saw during the Depression of the 30s, and what we saw during World War II. So this is an exceptional shock that I think gave a lot of latitude, precisely because of the significant market dysfunctions. Governor Lesenia highlighted this. The exceptional market dysfunctions, it provides a lot of space and indeed need for central banks. It was done through asset purchases or more traditional forms of liquidity provision. It provided an exceptional opportunity for central banks to support what was then, we have to go back to the mentality of the spring of last year, and what really looked like at the time melodrama, the end of the world. If you look, I have in my own work constructed measures of the VIX that date back to the late 1800s. And the last time that we had seen a spike in the VIX and a reversal, a sudden stop in capital flows to emerging markets, order of magnitude of what we saw in the spring of 2020 was at the very height of the 1930s global depression. So it was very exceptional, and I would be very hesitant and comfortable in extrapolating that under more common or standard circumstances, emerging markets are ready and able to rely on QE or indeed, very aggressive reductions in interest rates in the face of adverse shocks. It importantly depends on what kind of adverse shock we're talking about. So that's what I'd like to say about exceptionalism. The other term that I want to focus on is turning point. It is very difficult. Notice that in all of us have used the word temporary versus permanent. Ex ante is very difficult for monetary policymakers, for policymakers in general, to know which shocks are transitory and which shocks are permanent. I would note that we are an exceptionally, right now, I really have a great deal of sympathy for the difficult position that central bankers across the globe in varying degrees, both advanced and emerging market economies, find themselves in, because in the last 20 years or so, the tendency in fiscal policy has been to take, especially in the advanced economy, declining interest rates as a baseline. And therefore, you're less concerned about taking on debt, less concerned about large deficit because rates are low and are expected to remain low forever. On the monetary policy side, especially again in the advanced economies, but also we've seen this in EMs, the trend has been towards lower inflation rates and more convergence. And so what we're seeing really in the last few months is a big challenge to that. And hence the question of are we at a turning point? And specifically, is inflation of a transitory nature, or few things in life are permanent, but some of them are quite persistent, or is this a more permanent turn of events here, importantly pushed by significant dislocations and supply shocks associated with the global impacts of COVID? And ex ante is very difficult to know that, but I agree with governors have said very much that credibility is difficult to gain and easy to lose. And also economists have to remember that should approach this issue with great deal of humility, because the profession as a whole does very poorly in picking out turning points. And we may very well be at a turning point. It's difficult to say, but I think on the issue of credibility, can QE policies or exceptional liquidity and low rates be extended? Simply on the very legitimate basis that recovery has been halting, recovery has been disappointing, but notwithstanding that, I think the risk to credibility and the inflation concerns loom very large, especially in the context of emerging markets. And I'd like to end my remarks by reminding everyone that inflation is a very regressive tax, and that the fallouts that, again, to what extent central banks can do a great deal about this is a subject of great debate, but inequality has been, one of the issues that we had been worried about even before COVID, even more so after COVID. And I would remind everyone that inflation is indeed a very regressive tax, often accompanied, as it has been now, with large spikes in food prices and energy prices, which disproportionately affect low-income households and firms, and across countries has a disproportionate impact on EMs. So I think for those reasons, that central mandate central banks price stability should in the current conjuncture also get a high weight, despite the fact that we are still in a very uncertain process with uncertain prospects of when the full recovery from COVID will materialize. Let me stop there.
Thank you, Carmen. Another very, very clear and very deep exposition of the issues. We have heard a lot, so let's open the panel for a discussion. So let me kick it off with a question to Lesetja. Do you see the use of unconventional monetary policy by emerging markets as an exceptional response to the COVID crisis, or is it likely to play a more dominant role going forward for emerging market central banks? How can emerging markets benefit from these additional tools without taking uncomfortably large risks? Lesetja.
Well, Tobias, I mean, we keep on saying unconventional. The truth is these tools have been around for some time. The point here is that the tools are supposed to be used for a particular purpose. And in a way, what we saw in 2020 was that exceptionalism that we had. And because of that, it gave the space for emerging markets to deploy these tools. But the question that have to come is, how do those tools support both monetary policy and financial stability mandates of the central bank? Up now, emerging markets have rarely used these tools. With significant changes in market structures or nature of macroeconomic shocks, relying on unconventional tools as an exceptional response remains appropriate. But then, typically, when we deploy these tools, we deploy them alongside the other tools that we have in our toolbox. And at least for us in South Africa, we still had the space to utilize our key policy tool, which is the policy rate, and we utilized that first before we deployed these other tools. So the interesting thing to also note in our case was that the decision to deploy the asset purchase program didn't form part of an MPC decision. It took place as part of the executive decisions of the bank to say there is a dysfunction. What are we going to do about this dysfunction? And it became important so that we distinguish that these tools were not being deployed to deal with the mandate of price stability, but with that of financial stability, in the sense that there was a market dysfunction. In a forthcoming paper on by the staff of the bank, points are being made, which are, I'm sure they will be applicable to the other emerging markets, is that, firstly, when you are moving from a position of a weak fiscals, you could actually weaken investor confidence about the objectives of the purchase program. That is, whether it is intended for deficit financing or even artificially suppressing bond yields. There is an equivalence argument that goes with this. One can achieve the same effect of lower average borrowing costs by issuing more short-term debt. In some sense, the government would effectively be making its own QE rather than being done by a central bank. Secondly, is that if the central bank is expected to provide backstop against liquidity shocks in order to preserve market functioning, this might remove an important source of fiscal discipline. The point here is treasuries know that the market can only absorb so much of their paper. Once there is a ready buyer like a central bank, the dynamic changes, and it might not be that easy to win the treasuries of the cheap money that comes as a result of central banks' asset purchase programs. So the point here is these were tools deployed during wartime, and that it's not tools that you just easily deploy because it could disturb that important balance between the role of the fiscal authorities, role of the monetary authorities in this space.
Thank you, Lesetja. And We heard from Elvira that the Bank of Russia did not use asset purchases. So my question to you is, are there states of the world where you would see that the balance between the moral hazard that you explained and the potential benefits of intervening asset purchases to restore market functioning that Lesetche was describing in the case of South Africa? Do you feel that there are some states of the world where the benefits might outweigh the costs, even though in the COVID crisis, in your view, they did not?
Of course, this depends on this situation, yes, and the market dysfunction nature. But we see that in 2020, emerging markets purchases for financial stability reasons and were mainly aimed at compensating government bond sell-offs by non-residents. That is, the central banks stepping in as the investor of last resort. And if purchases can't be avoided without putting financial stability at risk, I understand that in some cases it is needed, then it is the central bank's task that they are structured in the way consistent with the measure's objective. It's easy to clearly draw the ex-ante line during purchases and after the completion. Nevertheless, as I said, we understand that purchases for financial stability reasons are of temporary nature and are aimed to address market dysfunctions. When the appropriate conditions come, these are to be sold at market prices. Balance sheet normalization to pre-crisis levels is quite fast. Purchases for monetary policy objectives are made at effective low bound to bring inflation in the target are also of a temporary nature. Balance sheet normalization can take longer, but it should happen nevertheless. Otherwise, the specter of the perceived fiscal dominance will eventually emerge. I think it's one of the main danger. And thus I see two key issues limiting purchases for financial stability purpose in emerging market and developing economies. And this it can be the case. The first is the volume of these operations. The existing logic of the central banks propagate that intervention to arrest the financial stability risk is a blank check, signaling that central bank would do whatever it takes to restore financial stability. Otherwise, it's not credible and will be tested by the market. Advanced economies, especially those with reserve currency status, can afford very large volumes of purchases, but emerging markets cannot. Emerging markets' large volumes by themselves may exacerbate capital outflows, leading to sharp depreciations in the exchange rate and a rise in inflation. This actually calls for extra care when unsheathing this tool. It's truly a double-edged one and shall be reserved for the times of clear and present danger to stability of financial system. This situation when financial risk cannot be addressed by the financing operations, I think. We truly do not know when the next time the events demand the use of this tool. And the policy space should be recreated before that hour strikes. For example, we use this approach when we conduct foreign currency operations for financial stability purpose. You know that the Bank of Russia often buys foreign currency market for the Ministry of Finance as prescribed by the budget rule. When we confront elevated market volatility, we often make pauses in these operations. However, we rebuild this stock of FX later on. I think if these asset purchases are used, the same approach is needed. And You know, I agree with Carmen about the exceptionalism of this instrument. And I agree that last year experience with QE in emerging markets says little about ability of emerging markets to use the same policy if volatility will go up because of Fed tapering, for example. That's why, you know, we are very curious about this tool, and I understand that the cases can be warrant this the use of this tool, but I think this experience has a very limited lessons that we can draw, because the situation was very, very exceptional.
Thank you, Elvira. You clearly agree with Carmen's notion of the exceptionalism of last year's events, and that means that asset purchases really should only be used in very exceptional circumstances in the vast majority of emerging markets. Of course, you did mention there are some emerging markets, you know, that are perhaps closer to advanced economies, are perhaps at the boundary of becoming advanced economies, that have used a larger scale asset purchases, but that is really a very, very small fraction. Now, let me turn to central bank independence. Central bank independence appears to become under pressure in emerging markets, as fiscally strapped governments have relied on direct central bank financing and more persuasion to limit interest rate hikes. You know, this is in other emerging markets, not represented here, of course. Against this backdrop, how do you think that central bank independence can be safeguarded? What is the role of legislation as well as communication and transparency?
Tobias, that is a great question. The one thing I disagree with you with is that this is just an emerging market problem.
Yeah.
I think this is an advanced economy issue as well.
Yes.
If you look at the and again, this goes back to the issue of what is temporary, what is permanent. The massive QE policies and exceptional by the standard of the day easing that took place around the global financial crisis 2008 2009 and its subsequent years, only a modest degree of that was reversed. So central bank balance sheets in the advanced economies, and I'm going to certainly speak to the emerging market question, but I'm making the point that central bank balance sheets had a significant ratchet up in purchases of government debt, central bank hold government debt. And of course, COVID came after that, and now central banks, the advanced economies, more so than emerging markets as a whole, have record peacetime holdings of government debt in their balance sheets. I think, though, in terms of signaling, this is troublesome for, you know, it's a troublesome signaling for EMs that you know, that may try to replicate what advanced economies are doing. And I do think that the issue of fiscal dominance, which, look, I'm not saying advanced economies, central banks have lost independence de jure, but I think de facto we are moving very much in that direction. And with emerging markets, of course, the issue at this stage is not so much that because if you look at most emerging markets, their the share of government debt held by the central bank is actually lower than what we see in the advanced countries. But the concern, of course, is that especially in an environment in which recovery is delayed, in which deficits remain large, and governments continue to rely on debt financing, that more and more pressures will uh, um, be placed on central banks. I do think that in the end, it's very difficult to overcome that. If I mean, the cases where that fiscal dominance has not been an issue is in countries that don't have their own currency. But it's a very difficult challenge. But let me leave you that the fiscal dominance issue may also come in more subtle, somewhat more subtle forms, but in the end also come back to the same issue, which the more subtle variety may be also in the form of financial repression, in which it's not necessarily reliance on the central bank to buy government debt, but reliance on the local banks to increasingly be the buyers of the rising levels of government debt. This in the end creates a problem, right? Because if there are any issues with government debt, the portfolio of the banks are impacted in any way, usually the last resort, what are private debts before a crisis become public debts after. So in the end, also central bank will probably have to play a role in stepping in and supporting the bank. So I think on the fiscal dominance issue, we need to be guarded, not to make the message convoluted, but we need to be guarded, not just safeguarding the balance sheet of the central bank, but also it extends to safeguarding the balance sheet of domestic banks as well.
These are certainly very stark insights. It's not just emerging markets, also advanced economy central banks have to worry about threats to independence. And it's not only the central bank, but also commercial banks that can be subject to financial repression. History has shown these lessons again and again, and it is extremely important to keep them in mind in the current environment. So let me get to Lesetja and ask, when unconventional measures or asset purchases or funding for lending programs are being used, oftentimes central banks are then pressured to retain those tools for less suitable goals, such as providing longer-term credit to favored sectors and similar objectives of the government, so that the primary objectives of the central bank being aligned in order to achieve lending or growth objectives more broadly. So this is really threatening independence. So what is the risk of that, and how can the bank defend itself against that threat of being undermined?
Well, in a way, central banks have got to stick to what they are good at and leave the allocative decisions to publicly elected officials. I mean, if government has got favored sectors, they must make an allocation on budget for those favored sectors and not burden the central bank run by technocrats to make decisions that are of a big public choice nature and really are political in the making. So now, as we embarked on all of these measures, and it didn't help that there was a narrative that said central banks were the only game in town, but when you looked at South Africa's response last year, there was no fiscal space, and all the response to the crisis that had to do with money was basically the central bank, whether it was the adjustment of the policy rate, the relaxation of regulatory standards, the bond purchase program. That was really the central bank coming to the party. My fear is that society will then end up with an inflated expectation of what central banks can do, and thus burden central banks with even more responsibilities that central banks are incapable of executing. And in that respect, almost set up the central banks. Measures that were taken during a wartime, so to say, and that these are tools that you deploy when you are faced with such a challenge and should not be just easily deployed. So one chap said that all of these unconventional tools, we must watch it very carefully, because it's tantamount to leaving a loaded shotgun with people with very little knowledge. So what's been happening? As we deployed these tools, society is having even more expectations to say, deploy them in this manner, deploy them in this other manner, and politicians, political leadership, thus also have expectations. And me, meant that the measures that treasuries and governments were taking, which themselves were supposed to be temporary, the governments get addicted to the era of cheap money. And as you see now across the with inflation rising, and that central bank would have to live true to their mandate and take the appropriate steps to deal with the resurgence of inflation. And we can have a debate whether this inflation is transitory or not. What is in no debate is that it is here, and that if it is transitory has been a bit longer than normal, and at some stage central banks will have to prove their mettle and take steps to live through to their mandates. And this will pose a very important challenge for central banks because we have deployed these tools. At what stage do you withdraw them? And when you withdraw them, there is going to be a pushback from society, and there is actually be an expectation from society. Why would you want to take these tools away? Why now? And that, for me, is a challenge that central banks are going to face.
Well, Lesetja, you've managed to scare me this morning. These are certainly scenarios that we have to take very seriously and worry about, and make sure that we don't end up in a place where central bank independence is undermined. So Elvira, you shied away from small asset purchases, but some emerging markets have conducted even large-scale asset purchases, i.e. asset purchases of domestic bonds or sometimes foreign bonds to ease domestic financial conditions. So any thoughts around that? What the preconditions would be for countries to do that?
Emerging market and developed economies inflation targeters, due to the structures of the economies, usually have high inflation target, and the neutral rate higher compared to advanced economies. Therefore, they on average shall have a larger headroom of conventional policy space, and hence probability that they will be necessity to resort to large-scale asset purchases with monetary policy, I think, is lower than advanced economies. This is also evidenced by the study of the IMF. Only a few managed to make some very small footsteps in directions advanced economies. In some instances, credible inflation targeted emerging market central bank faces limited conventional monetary space and sees a appeal to embark on this road. And I think it's as if conventional monetary policy space is limited, emerging market countries can undertake non-conventional monetary policy measures. However, once again, should design them with more care in order to be able to credibly tighten monetary policy when inflation pressures build up again, as for example is happening now, because the trust space in the markets is more limited, and when they use non-conventional measures for monetary purposes, even it's warranted because they are at low bound, they should be more careful about the design because the perception of these unconventional tools can be more with this flavor of fiscal dominance, fiscal dominance firstly, and it can undermine the use of these tools credibility. And I agree with Lisetti, I think it's very important. And but I think there are limits of such instruments, and we see now the limits of the perception that central banks can be not only the only game in the town, but that can do everything with these unconventional tools to support financial conditions. But there are obvious limits. You can see these limits. It's the rise in inflation, global inflations, and it's one bell that can lead to this alarm of that these tools are not limited. They can be successful in any case.
Thank you, Elvira. And my last question goes to Carmen Reinhardt this morning. You explained already the difficulty in distinguishing transitory versus permanent shocks. And of course, central banks around the world are struggling with coming to terms as to whether these supply factors in inflation are transitory or permanent, or a very long transitory or a short permanent. So how would you see the situation right now, and what does it mean for monetary policy, both conventional and unconventional tools?
Let me start with the second part of your question of one supposed lesson that we had taken from the experience of the 1970s, when most countries were faced by oil shocks. At that point in time, the recurring attempts by central banks, notably the Federal Reserve, to offset the adverse economic consequences of the supply shock led to an accumulation, a building up of inflation until ultimately by the late 70s, inflation in the US was around 14%. And in many advanced economies, including the now notoriously deflationary Japan, inflation was well over 20% at that time. But a big takeaway of that experience was that central banks are much better poised to cope with aggregate demand shocks than they are to remedy the effects of supply shocks, whatever the source of those supply shocks may be, which brings me to the current situation and your question on temporary versus persistent versus permanent. And as I said, few things in life are permanent, but many are persistent. And the big difference. We came into this, we meaning the advanced economy, central banks, and therefore the global setting for global interest rates and liquidity conditions, with the experience of the 2008-2009 crisis, which it's called the global financial crisis, but it really wasn't global. It was a crisis in about a dozen advanced economies who had built up very bubbly property markets and over-leveraged financial institutions and households. And so the setting of the 2008-2009 crisis, with a big decline in aggregate demand as housing prices came down, and the over-leveraging of households and financial institutions really bit, and credit crisis began to evolve, the aggregate demand decline was monetary policy played a huge role. Enter COVID, and we think we can do the same on an even bigger scale. And this is not a criticism of what I think the central bank aggressive easing in the height of the pandemic in 2020 was perfectly appropriate. This is a global meltdown at the time. However, since then, it's become very clear that what's been driving inflation up is not, it's very much associated with all kinds of bottlenecks, with huge spikes in transport costs, with, very big mismatch between labor needs in the transport area and in docks, in ports, the relocation of supply chains. These things, it's very difficult to expect that a central bank can fix that. And I think this goes into the mission creep problem. And I think we're forgetting also the lessons of the 1970s. And so for the reasons I've outlined, for the importance of supply shocks, I think that what we're seeing has an important persistent component. I hesitate to call it permanent, but certainly an important persistent component. And let me add, and I'll conclude here, that a factor that makes it the inflation issue more or the inflation spike. Let's not forget that in the US, CPI inflation is at a 30-year high and PPI inflation is at a 40-year high. What makes inflation more persistent, and certainly what made it more persistent in the 1970s, was central banks doing too little and too late. In other words, trying to accommodate and offset the adverse effects of the supply shock. So persistence in inflation can be built through the origins, supply shocks, the policy response, too little, too late, and the fact that a combination of those two things begins to build up inflationary expectations, which we are seeing notably drift higher.
Thank you, Carmen, and thank you, Elvira and Lesecha, for an incredibly insightful panel. I think also very panel. I think we have discussed many challenges that central banks are facing today: the potential loss of independence, the challenge of persistent inflation, and of course the many monetary policy and governance issues that are at the forefront in this pandemic. Let me thank you for the participation and turn back to Deputy Managing Director Bo Li.
Thank you, Tobias. Thank you very much for very distinguished speakers today for sharing with us insightful discussion on unconventional monetary policy tools for EMD, but also in a broader context, not only for EMD, but for a lot of advanced economies as well. I think these things strike me as very very memorable from today's discussion. I think one is the need to be cautious in interpreting the unconventional monetary policy operations by EMDEs in 2020. I highlight 3 risks, but I think our speakers added a lot more in terms of the exceptionalism, the danger of moral hazard. There are many things that we should be careful about in interpreting these operations last year. That's the first thing. I think the second is that we also hear the need for EMDEs in particular, also probably also include advanced economies, to continue to improve or safeguard monetary policy credibility. Monetary policy credibility is key to a successful monetary policy operation, both conventional and unconventional. And we hear there is not only a danger of such credibility challenge in EMDs, but also possibly in advanced economies. But I want to highlight that in particular for EMDs, some unconventional tools are actually used very frequently in the past. For example, yield curve control, because traditionally the monetary policy transmission was not very good in many EMDs. So many central banks engaged in yield curve control or direct interest rate control. And those operations, as we have heard, there are many risks to such operation. And for those central banks, we would urge continued improvement in monetary policy framework, in central bank independence, in governance safeguards, and also in a simple and clear objective around price stability. Because we see for some central banks, there are also the challenge of multiple objectives and not clearly articulated. So given all these challenges, we see there is a continued need for improvement in monetary policy framework in many EMDs. And finally, we hear is the need to further develop financial markets among EMDs. Deep, liquid, and efficient financial market will be key to successful monetary policy operation, both conventional and unconventional. We have talked about the inadequate monetary policy transmission in EMDs. We have talked about the harm, the damage to market functioning during the crisis. If we have a deep, liquid, and efficient financial market, this will improve monetary policy transmission. This will reduce the need for unconventional monetary policy operation in face of turbulence. And also, in addition, if central bank does need to intervene, this will provide a good secondary market for intervention, will reduce the need for primary market intervention that will increase the danger of fiscal dominance. So we see these three needs. And as Tobias already mentioned, we hear a lot of challenges to effective monetary policy operation going forward, both unconventional and unconventional. But we are hopeful that we can continue to engage in dialogue and discussion in all these very important issues going forward. And the fund, the International Monetary Policy Fund, will be happy to continue to serve as a platform for such discussion. Thank you very much.
Thank you very much, Deputy Managing Director Bo Lee. And thank you for our panelists this morning, Lesetja Kayango from South Africa, Vera Nabulana from Russia, and Carmen Reinhardt from across the World Bank. Thank you for your time and for a tremendously useful discussion. Have a wonderful day.